Good afternoon, everybody. Thanks for joining us today for our home buying webinar. My name is Carla Giacomini, and I'm the Director of Marketing here at Alterna, and I'm excited to be hosting this webinar today. Throughout the next hour, we're going to talk about what's trending in home buying, and we're going to walk you through some of the things you'll need to know before you start either buying your first home, switching your mortgage, or refinancing. Excuse me. Before we start the webinar, I wanted to take care of some housekeeping tips. So first of all, participants are going to be in listen only mode. Secondly, we'll be taking questions. So you can actually ask questions through the Q&A function on the bottom panel of your screen. Feel free to type in your questions. We're going to do our best to get to every single question and answer it time permitting. If for some reason we don't have time, we will get back to you with answers to your questions. The last thing we wanted to talk about is the recording. So the webinar is being recorded, and we will actually post the recording to our website and also send it to you via email if you want to look at it at a later date. So we're going to go to the poll. Before we get started, we want to hear from you, and we're going to do a quick poll. So it's anonymous, and so please just answer yes or no, and you can just click submit. So the poll is: Are you planning to buy a home this year? So yes or no. And we're just going to wait a few seconds until everybody has a chance to actually put in their answers. Yeah, so I guess were people are still putting answers in. Maybe we'll just give it a few more seconds. Okay, I think we can end the poll, and we're gonna pull it up on screen so you can see. As you can see, we had people saying 29% yes, they are looking at buying a home. Other people no, and potentially maybe just looking for future. And other people said maybe, which is great. And I hope that this session will help provide the information you need within your home buying journey. So. Uh, Thank you for participating. I just wanted to now talk about our presenters. So we have two mortgage experts. We have Adam McLean, who served the Ottawa area for over 18 years, and Jason Dorian, who served the Toronto region for over 10 years. They're going to be taking you through, everything you need to know about home buying. And as I said, don't be shy about, asking questions in the Q&A. They will be more than happy to answer them. So we're going to go through the agenda today. We're going to talk a little about the alternative difference. I know a lot of you are members, so you may know, but this is just a refresher. Jason's going to take us through the trends, what's happening in home buying currently, and then they both will talk a little about buying a home, switching, and refinancing. So I'm going to hand it over to Adam McLean, who will start us off. Welcome, Adam.
Welcome, Carla. I'm going to hand it over to Jason, who's
Oh,
actually going to start it off for
sorry,
us.
I'm sorry.
No worries.
Thank you, Adam, by way of Carla. So I guess I'll get us started. As Carla mentioned, we'll discuss a little bit about Alterna and the credit unions versus banks, and a little bit on the differences. Most of you already know this being members, but for those who do not or need a refresher, a credit union is member owned, so all of the profits are reinvested to serve our members. And in terms of our advice, we work every day to find unique solutions for our members and provide friendly, transparent advice to them. Generally, we have lower fees and higher interest rates on deposits than banks do. And we offer unlimited deposit insurance for eligible registered products and up to $250,000 for eligible non-registered products. We have the largest ATM network that is surcharge free across Canada. And credit unions' profits serve a purpose. We invest in the communities that we serve. And specifically the Alterna difference, we're just like a bank, but better. Alterna has been proud to offer financial services to our members for over 100 years. As a financial cooperative, our profits have a higher purpose. We are the good in banking. And what does that mean exactly? We offer great rates. We give you good, honest advice because we do care. We offer innovative banking solutions. We invest in your success. We put people above profits, and we invest those profits in you and your community. And lastly, the main thing is we're member owned. So we are members serving other members like you. And that doesn't necessarily mean that we are not full service as a financial institution. We offer a large variety of products and services, including checkings and savings accounts, wealth management, mortgages and loans, small and enterprise banking, investment planning, banking for nonprofits, retirement planning, and different ways to bank. We have our branches that you can go into in person and deal with people in an in-person setting. And we also have online banking and mobile banking to make it more convenient for our members. And now for what you've all been waiting for, what's happening in real estate in 2023. So I'm sure everybody wants to know what's going on and where prices and rates are going. So we'll start off with some national trends for 2023. And we have seen a decline in average GTA home prices for the month of May year over year, and that's 8% in the GTA, with 9% in Ottawa and an 11% decline overall in Ontario. However, I would caveat that with April to May, we saw roughly 3% increase in prices in the GTA. So prices may be starting to pick up again as compared to the decline year over year. And that's forcing about 33% of Canadian home buyers to consider workarounds to buying a home. And whether that's specific to down payment or just qualifying overall in terms of adding other people onto the application to qualify with more income, many people are looking for these workarounds to be able to get into the market. The prime rate has soared from 2.7% a year ago to sit currently at 6.95%, which is a huge increase. And lastly, the average condo price decreased to $701,000 in the GTA, and that's down 11.4%, which is a pretty significant drop. And in terms of the housing market outlook, CMHC is expecting a home price decline to bottom out sometime in 2023, and we may have already gotten there, judging by the latest numbers. Last week, the Bank of Canada announced a rate hike of 25 basis points to 4.75%, and that's obviously going to have a big impact on variable rate and those holding variable rate mortgages. Housing prices could start to rise by 2024 due to renewed demand and persistent supply gaps. And again, I think we're already starting to see a bit of that already as of this year. And CMHC expects the average 5-year fixed mortgage rate to be 5.7% in 2023 and sees rates falling in the coming years, dropping only marginally to 5.6% in 2024. So these rates are here to stay for the next little while. The rental market will become more competitive, and that's going to put pressure on rental costs as the supply becomes tighter. Also, with the rise in interest costs, many landlords are going to be passing on those increases in the mortgage payment to tenants through increases in rent. And now I'll pass it over to Adam to discuss buying a home.
Thanks, Jason. Welcome, everyone. Thanks for joining today. I'm just going to go over buying a home, renting or owning. That's the big question, right? So should I rent or should I own? There's pros and cons for both. Honestly, it really comes down to what's best for you and your family. So right now I have laid out some pros and cons for each. So first, renting, one of the pros is a big one. So your payment stays the same. So month in and month out, you don't have to worry about a fluctuating payment. At least for the first year, you know that your payment is going to be that. It's not going to change. Also, the landlord handles the repairs and expenses. So again, if a big storm rolls through and all the shingles fly off your house, you know that you don't have to have put that money aside. It's the landlord's responsibility. So you have peace of mind in that sense. Some of the cons would be that you're unable to make renovations. So the way that you moved in is the way that it has to stay. You can't just go and make changes to the property. If you wanted hardwoods and there's carpet, you have to live with carpet until the landlord decides to change it. So that's definitely a con. and you may be forced to move based on the landlord. So you don't have that sense of security and stability because they could decide to sell it tomorrow and then you're going to be forced to find a new place right away. For owning, some of the pros are you do get that stability and a sense of a greater sense of community because you know that you're not going to be forced to move. You can stay there for as long as you want. And you do feel more rooted in the community just because you own a house on that area, neighborhood, and it's yours. Helps build equity. So equity would be the price of your house minus the mortgage amount that you owe. So over time, that will build up as you pay down your mortgage. And that's a great thing to have in your back pocket and a good investment. Real estate has always been a good investment, especially long-term. So if you had bought 10 years ago and where your prices are now, you know the huge growth. So it's always proven to be a good investment. Even if there are volatility in the market, long-term, it has always proven to be a good investment. Some of the cons are you're gonna have monthly expenses, month to month, more than you would have when you're renting. And also the maintenance and other financial obligations that we spoke of. So if, like I said, something happens, if your roof starts to leak, you're gonna have to repay that, fix that yourself. So some of the costs of ownership, you should know ahead of time before going into buying a house. So the closing costs, so the appraisal registration fee can range from $750 to $1,000. The minimum down payment requirement you're gonna have to have is 5% of the purchase price. The land transfer tax can vary to 0.5 to 2.5 based on the value of the property that you purchase. Mortgage insurance premium can range from 4% to 0.6. We'll have another slide later on to go on exactly what that is. Legal fees and disbursement costs can go $500 to $1,200. So that's why it's important to call around before you find a lawyer to make sure that you're getting the best deal. And home inspection, $400. This is well worth its weight in gold, just knowing that you're buying a house and you're not going to have any skeletons in the closet later on, then you're actually buying the house that you see. So those are some of the fees, and ongoing monthly costs that you'll have would be property tax, property insurance, your monthly utilities, maintenance and repairs, as we talked about, and land maintenance. Another one that might come up if you own a particular type of property is a condo fee. So you would have that on a monthly basis as well. All right, so to determine if you're ready, you need to know these 5 steps. And that would best suit you in the position to know that you're going to be buying a house. So do you know how much you can afford to spend on your first house? So number one, going in and sitting down with a mortgage advisor, making sure you do a pre-approval. They're going to be able to capture everything for you and tell you exactly how much you can qualify for based on a number of things that you have. Number two, how much have you saved enough for at least 5% of your down payment for your first home? So have you saved any, started saving any of your down payment? Do you have a down payment? Those are the questions you're going to have to ask yourself, how much you have. Do you have a credit history? So have you applied for credit? If you haven't, it's a good time to go out and establish a credit history because you're going to need to have a good credit bureau to apply for a mortgage. So going out and getting a credit card or a small line of credit is always preferred so that you can at least start to establish that credit history. Do you have a healthy credit score would be the next one. So have you pulled your credit bureau? It's always recommended you at least pull your credit bureau once a year to make sure that your credit score is healthy. Nothing has popped up that you're unaware of. Sometimes other people's stuff can get put on your credit bureau by accident if they have a similar name. So doing that as a financial check to make sure that you have nothing on there is a great thing to do, and it will allow you to know where you stand. And do you have a handle on your credit and debt? So making sure that you don't have a ton of other financial obligations is going to make it easier for you when you do buy a house. Number one, you're going to qualify for a lot more, and you'll have the peace of mind knowing that you'll just have your mortgage payment and those other ongoing monthly obligations, but not a ton of other stuff. So down payment. So down payment is really the money or percentage of purchase price that you pay up front. So you have a lower down payment and lower mortgage payment. So when you pay 20% of your down payment or more, it's considered a conventional mortgage. So banks can insure mortgages up to 80%. And when you have less than 20% of your down payment, it has to be considered a high ratio mortgage. And those are insured by default insurer, CMHC, Sagen, and Canadian Guarantee. And they charge you a premium that gets added onto your mortgage that you pay over the term of your mortgage. So that is a good way for you to get into getting a property, but you wouldn't be able to get it typically if they weren't able to insure. So what is mortgage insured? So I alluded it slightly on the last slide. So mortgage default insurance protects the lender in case the borrower defaults on the mortgage. Is a requirement for all mortgages with a down payment of less than 20%. So again, if you don't have a 20% down payment, you get your mortgage insured through those three companies. They're going to charge you a premium, but it allows you to get into the home market, buying a house for the first time potentially, and you only have to pay as little as 5%. They will charge you a premium, but it gets added onto your mortgage, so you don't have to pay it all up front. It'll just get paid as an installment as you make your payments monthly. All right, another poll. So Carla, I think you're gonna fire this one up.
Yep. Thanks, Adam. Yes, time for another poll. And as I said before, questions are pretty easy. Just feel free to choose whatever is on the screen. So the poll is, what does best describes you? I am a first-time home buyer looking to switch my mortgage or looking to refinance. So if you just want to join, hit, and we're going to share the answers with everyone as well. Just give it a few seconds here as people enter the responses. Okay, let's show the, a couple more. Oh, a few more coming in. Okay, Gal, do you want to share the responses? So as you can see, we've got about 46% are first-time home buyers in the audience. There's 24% looking to switch and 32% looking to refinance. So I know there's some questions that have come in on the refinancing piece, so we will definitely get to those for sure. Okay, we're going to keep moving, and Jason's up next.
All right, it's actually me, Carla.
Oh, sorry. I'm sorry.
Just trying to pass
I
it up.
can't get this right today.
That's all right. It's all right. So yeah, so how to start saving for your down payment. These 4 steps are really going to help when you're going to potentially buy your first house. So number 1, start investing in high interest rate saving products. So putting your money in high interest rate savings, checking accounts, something that earns more than a checking account of 0. You can also look at redeemable investments. Usually with Alterna, they have a 1-year redeemable. So after 60 days, you can cash it out at no penalty and you earn the interest up to the date that you have it in there for. So that's a good option. The first time home buyers program. So investing in your RSPs you can use when you go to buy a house for the first time. Also the new TFSA. These are ways to take out money out of your investments without paying any tax, and then you're able to use it to buy your house, and then you can pay it back slowly after. Paying off your debts, obviously the least amount of debts that you have is going to make it, number 1, easier when you go to buy your house because you won't have those monthly financial obligations, and you're going to be able to put that other money aside towards your down payment and finding cheaper ways to do things. I think this works the best, and it's simple things that we can do that make a big bang at the end of the day. So maybe not going to Starbucks and buying a $30 coffee, making coffee at home, or not eating out as much or doing Uber Eats. The surcharges and fees with those are ridiculous. So just spending that money and buying groceries at the end of the day going to make it a huge difference in your bank account and save yourself thousands that you'll be able to put towards your house. So now I'm going to pass it back to Jason.
Thanks, Adam.
No problem.
So as Adam mentioned, there's a lot involved in the process of buying a house, and a good step to take, and we'd like to discuss the importance of a mortgage pre-approval. You're pre-approved for a mortgage once the lending institution, such as Alterna, has vetted you for a specific mortgage amount after reviewing your financials. And specifically, we look at your income and your credit. And by doing a mortgage pre-approval, you'll know what you can afford to spend on a home. So you'll know, your mortgage amount, that the maximum amount you could qualify for. You'll know what your interest rate is, and you'll know how much your monthly payments will be. So those three things are very important to know when going into a mortgage.
It's also, well, if you just want to go back for 2 seconds, it's also a really great thing having the pre-approval. So you're like, even if you're unsure, if once you have it, it's easy to renew as well. So we'll just have to pull your credit bureau again, and then we can have it renewed, extended for another 120 days. So don't worry if you don't think you're going to buy right away. It's a good thing to have in your back pocket in case something comes up, and it's easy to renew as well. Thanks, Jason.
I think we should also mention, Adam, that in this environment of rates that keep going up, it's good to lock in a rate with a pre-approval, because you never know. It seems
Absolutely.
like a week now rates are going up. So having that rate locked in will make sure that you're getting the best possible rate at that time.
Absolutely.
So does getting pre-approved for a mortgage guarantee that you're going to get a mortgage? And the short answer is no. Generally speaking, when you do get pre-approved, you will be approved for a mortgage. However, it's not the same thing as a final approval on a mortgage. If you make an offer on a property and it gets accepted, we'll still take additional steps verifying certain things before giving you the final approval. And that could be an appraisal to make sure that the appraised value of the property is satisfactory. It could also be checking your credit again if it's been over 30 or 60 days since we gave you that pre-approval, just to make sure that there has been no major changes in your credit. Which leads us into a good question of, what is a credit score? Credit score is a 3-digit number that's a prediction based on statistics of your credit risk at a specified point in time. And the key phrase there is specified point in time. So the credit score is as of that point in time, that day. The higher your score, the more likely you will be approved for a mortgage. And in some cases, it can also give you a better rate. The maximum credit score you can have is 900. And generally speaking, a score between 720 and 780 is considered to be pretty good. What affects your credit score? And Adam spoke to this a little bit earlier, but specifically, there are a number of things that contribute to that overall score. Debt, obviously, is a big one. So what do you actually owe, for example, on your credit cards, on your line of credit? The length of the credit history, how long have you had debt? How long have you shown that you can pay back those debts? And that goes into payment history. The number of credit accounts opened, or the amount of inquiries that you have on your credit bureau. If you have a lot of inquiries in a short amount of time, that can signal that you're taking on too much credit, or you're looking to seek too much credit, and the lender may not be really enthusiastic about that. How much available credit are you actually using? So you might have large lines of credit or large limits on your credit cards, but if you're not using them, that can also affect your credit score. And lastly, the mix of credit types. Do you have just 10 different credit cards? Or do you have a mix? Do you have a loan for your car? Do you have a couple of credit cards? Do you have a line of credit? So all of these things will impact the overall score. And you can go online and do a little bit of research if you'd like as to the different proportions of those things play a role in your overall credit score.
Yeah, and also the older trade lines you have, you're going to want to hold on to those, because those are really what show over history that you've paid back these credit lines. You going out and saying, I'm going to go get a pre-approval, I'm going to close all my debt, that's going to act in a negative instant on your credit bureau. So you're going to want to make sure you do keep those older trade lines open if it's like the first credit card or line of credit you have, because you want to make sure that they see the established credit history you have. And just make sure that it's not fully utilized, but you pay it off monthly, and that's a good habit to have.
For sure. And that perfect segue into, how do you improve your credit score? Number one, the big one, pay your bills on time. Secondly, pay off or pay down credit card balances if you're not necessarily needing to keep them. Order a copy of your credit report from the consumer credit rating agencies like Equifax or TransUnion. And Adam mentioned this before, but really important, check your credit report at least once a year to ensure that it's accurate. Mistakes happen. like you said, people with with similar names, or sometimes it's just a glitch or whatever it is. These things happen, and you want to ensure that it's got the right information on your credit bureau. And contact the agency if you do see an error, so it doesn't negatively impact your score and doesn't linger there and hurt your score in the long run. So, big question, what if you can't qualify for a mortgage on your own? There's something called multi-ownership, which is essentially obtaining a mortgage with other people, such as your parents, your friends, or other family members, perhaps a sibling. And this could be a great way to qualify for a mortgage. If you don't qualify on your own, we can add other applicants as co-borrowers on your application, and they will help you to qualify for a larger mortgage, perhaps for a property that is more within your range.
Yeah, it's also becoming a lot more common as well with the prices of houses now compared to before. So parents or grandparents are going on to mortgages to help the other applicants qualify. So it is a good program to have, and it's becoming more common as well. I'm sure, especially in Toronto, with the house pricing out there, that lots of people are taking advantage of that as well.
Definitely. And I'll pass it back to Adam to discuss fixed and variable rates.
All right, thanks, Jason. So fixed or variable interest rates, that's the question, right? So there's pros and cons to both. It's best to just know the pros and cons before you decide what you're going to go into. So as far as a fixed, the interest rate remains the same. So it's a nice thing, peace of mind, knowing that kind of like renting, you don't have to worry about the payment changing. If you're in a 5-year term, that's going to be your interest rate for the next 5 years, and it stays consistent. As far as the amortization, it ties into that. So you're going to know exactly how much is being paid. As the payment stays the same, your amortization is going to be on track. So if you have a 5-year term and you start at 25 years, you know, at the end of the 5 years, you're going to be at 20 years left. So it helps you stay on track in that sense. And a lot of people love it just because of the peace of mind. Some of the cons are that you can't take advantage if there are any decreases in the interest rate during the term of the mortgage. So again, it's one of the things you have to weigh before you go into a fixed rate term, because if the rates do go down, to get out, you're going to be paying a penalty, and the penalty might not make it worth you paying it right now. You might have to wait to get out to go into the new interest rate. So in a lot of cases, when I sit down with my clients, we have to weigh if it's worth it to pay the penalty or if they should just stay and then wait to the end of their term to go into another variable or fixed rate term. Some of the pros with variables are the interest rate are typically lower than fixed rate, but not always. So this was the case before when the interest rates were going on their record lows. Now variables are higher, so the fixed rates are more appealing, but that's not always the case, like it says. So it's something to look at, but historically they were lower. So that was one of the pros. And flexibility to convert to a fixed rate mortgage at any time. So with Alterna, you can move your variable rate closed term mortgage to a fixed of equal term or more at any time. There's no additional cost. You can just flip it over into that. So it's a nice thing having that flexibility. You can move into that. Some of the cons are that when rates go up, your mortgage payment goes up. So more will go towards the interest and principal. So kind of acts in the opposite way. It's going to affect a lot of other things when the interest rates go up. So your amortization may increase as well. So when you go up to renewal, again, your payment might have to increase to catch up from where you lost out with the payments, with the interest rates going up. So switching your mortgage. So anytime you're switching your mortgage, you can save money potentially, but you also have to look into it because there's fees involved. So going over these 6 options to make sure that you're in the best situation for yourself and your family moving forward. So number 1, your budget allows you, are you able to make additional payments to your mortgage sooner? So setting it up in a way when you're switching it over, if you can put additional payments onto your mortgage to pay it off sooner, which is always the goal, right? If you want to change your payment frequency, so instead of paying monthly, you can switch to bi-weekly or weekly. You have complete flexibility. Would you like to make additional payments? So again, at Alterna, we can do 20% prepayment privileges per year, per calendar year. So maybe with your institution right now, you're only allowed 15, and that's important for you that you can do more than 15. So that would be something to look at. Are you satisfied with the service and rates you're offered with your current lender? So maybe you went with a broker and they put you with this, like another institution that isn't as convenient for you to deal with. You have to think about that too, because maybe 5 years down the road, you're going to want a line of credit or you're going to want to refinance. You're want to be with an institution that's easy to deal with and and you're comfortable with who you're banking with. It's also a great time to consolidate any other debts you have, because you're going to be paying it at a lot lower rate on the mortgage than what you're potentially paying it on these other investment vehicles. So it would be a good time to consolidate your debts at that time. And review your options 2 to 3 months prior to your current mortgage term expiring. The more time you give us, the better your situation is going to be, because with Alterna, you can early renew in 120 days, so 4 months. We can also pre-approve you within 4 months, hold the rate. So at the end of the day, if you decide you're going to stay where you are, that's fine, but we want to make sure we give you the best possible rate. And doing that early is just going to help you. You just have to make sure that if you want to move forward, we will be pulling your credit bureau. So you just got to ensure that you can at least have that happen. All right, how to become mortgage-free faster, which is a great thing. So with Alterna, you can do it in 3 ways. So you can apply a lump sum at any time. So like I said, with Alterna, you can do 20% of the original mortgage amount per calendar year. So if you have a mortgage of $400,000, you can do $80,000 as a lump sum straight onto the principal per calendar year. So in November, you can apply $80,000, and then in January, it resets. You can do it again. You can increase your payments by 20%. So you can take advantage of that as well. And you can increase your mortgage frequency. So you can double up your payments at any point. You can do 1 or 3. You just can't exceed the total 20% for the calendar year, but you have complete flexibility. So this is just understanding the prepayment penalties. So if you're in a fixed rate mortgage, your penalty is going to be made up of if you decide to break it. So you win the lottery tomorrow, I don't need a mortgage. 3 months interest or the interest rate differential, it's always going to be the higher of the two. And when it says variable mortgage, it's 3 months interest. That's a variable closed term where the rate is variable, but the term itself is closed. Straight variable mortgages, you won't have any penalty, but the interest rate is always a lot higher. So in this instance, it's a variable closed. So it'd be 3 months interest. Now, on our website, there's a lot of resources. There's the prepayment calculator penalty, which if you have a mortgage with us now, you can plug in your details and it will give you a rough estimate of what your penalty is going to be. And again, the prepayment cap per calendar year is 20% with Alterna.
And Adam, maybe worth mentioning that it also can apply to people who are selling their home. Technically, they're going to have to break that term, but if they want to port that mortgage, as long as it's done within 90 days, then the penalties will be reimbursed to them.
Exactly, Jason. So you can port your mortgage. Also, if you're looking at a situation where you're doing bridge financing and you've purchased a new house, but you don't sell your current house till 2 months later, we can bridge up to 120 days. So that allows you for us to pay the down payment that you're going to be getting that you would have had if you sold your house, but we give that to the lawyer for you. And then when your house sale goes through, the lawyer will send us the funds. Thanks, Jason. All right, so these 8 steps are the guide to purchasing a new home. So the first one, make sure you understand all the costs involved in owning a home. So that second slide that I went over at the start of the presentation, making sure you're fully aware of all those fees. Getting a pre-approval, the most important thing, in my opinion, making sure that you understand fully what you can qualify for. It's going to make it a lot easier for you when you go out and look for houses, than not be disappointed if you just put in an offer and then you don't qualify at the end of the day. So really important. As important, well, maybe as important as finding a good mortgage advisor is finding a reputable real estate agent and lawyer. So going out and getting that great advice in their field of expertise. So the lawyer is going to do all the registration, and the real estate agent is going to go around with you and find that perfect, beautiful dream house that you've always looked for. Making an offer that fits your needs and budget. So again, if you do a pre-approval with Jason for 1.4 million in Toronto, you don't necessarily have to go out and buy a house at 1.4 million. You can find something that works in your budget. So at the end of the day, when you do move into your dream house, you do have food in the fridge, you have furniture, you want to find something that fits your budget. Getting a home inspection, I alluded to this again on the second chart. So it's important. It might seem like a lot of money, but at the end of the day, you want to know exactly what you're getting. You want to make sure that the wiring is good. You want to make sure there's no mold, because if there are anything and you find it out later, it's going to cost you thousands of dollars. So making sure that you do get that home inspection, it's going to pay off in the long run. Even if they find nothing, the peace of mind knowing that you've done it is going to be worth it. Finalizing your mortgage. So Jason alluded to this, when after you've done the pre-approval, it's not the final thing. It's sending us the purchase and sale agreement that the house you put an offer in, the MLS listing, providing us with your lawyer information, your proof of deposit, and just making sure that we have enough time to get the appraisal on that property. Once that's done, we give you the final approval. You can sign off with your agent and then move into your dream house. So that's it, these 8 steps, and you can have your new house.
So thank you both, Jason and Adam. Amazing information. You'll see here, you've got both of their, Jason and Adam's contact info. There's also a QR code, which allows you to book an appointment with them. So if you're interested, you can use that QR code, or you can simply email them or send them or give them a call. So we're going to go now to questions. There are quite a few questions that have come in the chat, and maybe Adam, I'll go to one that you just talked about regarding the pre-approved principal amount. So the question is it recommended to go above your pre-approved principal amount for mortgage when you have the down payment available, considering this is just to have more flexibility when house searching? What do you think about that, Adam? What is your recommendation?
Well, I mean, when you have the pre-approval, it's always good to stay within your pre-approved range. If you have a bigger down payment, it would be best to let us know when we're doing your application to get that included in there, so that we know exactly where everything is as far as the financials. And then that way you can have the option of at least going down, which is better than going up without telling us, because then that way you won't have any surprises at the end of the day.
Great, thanks, Adam. Jason, one for you. There was, and there's, so everybody knows, there are a lot of questions about credit score. So I'll just pass the first one over to Jason. Does the mortgage pre-approval affect my credit score?
The short answer is it may. Anytime you do a hard inquiry on your credit bureau, it has an impact on your credit score, in the sense that it shows that inquiry on the credit bureau. And if you have too many inquiries, obviously that'll impact your credit score in a negative way. But also it can impact your ability to get the mortgage, because when we're reviewing the application, if we see that you've got 8 mortgage inquiries, or 8 inquiries from mortgage lenders, I should say, in the last 60 days, for example, it may mean that you're having trouble qualifying, or you're looking for too much credit, more than you can qualify for. So in that sense, it can have an impact definitely on your credit score. But if you're using your credit responsibly, and you're not getting too many inquiries done, it's a very minimal impact.
Yeah, I would agree with what Jason said. As long as you're not going out and inquiring at a million different places all at one time, it's not really going to have an impact on your credit score. It's like he said, the amount of times you're going out, if you're going to a lot of different places, it's going to come across to the institution is that you're not qualifying, or maybe you're just unaware of that's a hard credit pull.
Thanks. We're going to switch gears a bit. And you talked a little about this, Adam. Can you repeat bridge financing and how it works? So maybe go a little more into detail, Adam, if you don't mind.
So yeah, so bridge financing works. So you've purchased your new place, and then you've sold your current house that you live in, but the sale of your current house doesn't come till after you've already moved into your new place. So essentially, we're providing the down payment that you would have had you have sold your house first, we're giving that to make up the total purchase price. So it would be the amount that you're planning on using a down payment from the equity of the sale of your house, plus your current mortgage that you're going to have with us. That would make up the total purchase price. And then when your house sale goes through, we would pay off your old mortgage, and then we would pay off the bridge loan. So you'd just be left with your new mortgage amount. It's a higher rate. So a lot of the times when I'm meeting with my clients, what we do is we do the mortgage, and I will just give them an equity line of credit, which has a lower interest rate. And that way it reduces the bridge loan amount, because the bridge loans would have a higher rate than what a secure line of credit has. And then later on down the road, it's there if you need it as well. So it works in a couple ways, that you have it for future use and you pay less interest with the line of credit. There's a $190 fee when you do bridge financing, but for a lot of these mortgages, we can cover up to $1,000 in fees. So we can usually cover that for you as well.
That's great. Great info, Adam. There's also, someone who's inquiring about the pre-approval. So Jason, this member, their mortgage is coming due in December, and they're asking, and they want to shop around, of course, for a better rate, and they're asking, should they get, or can they get pre-approved now?
For December,
This year? Yeah, their
yeah,
mortgage is coming due December this year.
right. So
Yeah.
we can hold the rate for 120 days. So we would have to go based on the renewal date, whatever that happens to be. Let's say it's December 15th. We can go back 120 days from there to do that pre-approval and hold that rate. So essentially, you would have to work backwards, go to your renewal date, and then go back 120 days from there, and that would be the first possible date that we could do that pre-approval to hold the rate until your renewal. So yeah, to answer the question, we wouldn't be able to do it from today for a renewal in December. It would be sometime, I guess depending on the date, probably like you're looking at closer towards September.
Great. Thank you, Jason. And Adam, this is kind of, you had talked a little about this in your last answer. Maybe you can explain a little more. Members asking, does Alterna cover any of the costs, for example, appraisal costs related to the application of a mortgage? Or when you're
Yeah,
getting a
so for
mortgage?
a lot of our cases, based on the amount of the mortgage that we're bringing over or doing as a new purchase or a switch, we can cover up to $1,000. So typically when you do, say, a new purchase, you're going to pay your at least your lawyer fee and your appraisal, which will be around $350. So in that case, we can cover up to $1,000, again, based on the amount of the mortgage financing we're doing. With a switch, the same thing. You're going to have your registration, which is around $500 to $550, and the appraisal $350. So if it's say $900, the $1,000 would fit inside that. So we try to make it as easy for you to switch your mortgage or purchase your house without incurring fees when we can cover them for you.
Great. Thanks, Adam. That's great. Jason, this was a little about what you talked at the beginning of the presentation. Members asking, my variable mortgage is up for renewal later this year. Should I go into another variable or fixed rate mortgage? What are your thoughts on that? I know it's you almost have to have a crystal ball, but
Well, if we can, it depends on what the outlook is in terms of the term. If you're going into something that's more of a 3-year term, I would say fixed rates are the way to go right now, just based on what we're hearing from both the Bank of Canada and also from CMHC in terms of their forecasts. It doesn't look like fixed rates are going to come down this year or next year, but doesn't look like the Bank of Canada rates coming down anytime soon either. So I think that the spread will still remain, with the variable being higher than the fixed in the short term in the next 2 to 3 years. So in my opinion, I believe the fixed rates are still the way to go. Generally speaking, variable rate is is only for a certain type of borrower. You have to have the income to support the shocks with the variable rate. If your variable rate went from 2% to almost 7% now, and you don't have the income that can support those fluctuations, you're going to find yourself in a difficult situation. And you might be getting a call from your branch to say, we need extra payments, we need a lump sum, we need to increase your monthly payment, those sorts of things. So generally speaking, I would say to go variable in the first place, you need to have that buffer with your income where it's not too close to your monthly expenditure. And at the macro level, I would suggest shorter terms, about 3 years, you're probably better off with the fixed.
Great. Thanks, Jason. There's another question regarding a mandatory 10% down payment. And the question is there a mandatory 10% down payment set by CMHC for mortgages over 500,000? I'm going to take that one, Adam or Jason.
Jason, you want to take that one or?
Yeah, so the minimum is 5% up to $500,000 for the purchase price. And then between 500,000 and $1 million, it goes up gradually from there. So for every incremental amount above the 500,000, so it may end up being, your down payment might end up being actually 7 or 8%, depending on the purchase price of the home. So the exact, you can go to CMHC's website, they have a calculator, you can put in the purchase price and it will tell you what the minimum down payment is. And that's probably the best resource to learn how that works. They also have great resources for first-time homebuyer incentive and how to get that incentive as well. They also have that calculator. So I would highly recommend taking a look at that.
Thanks, Jason. Another question, does Alterna offer an open mortgage?
Yeah, so Alterna has a completely open term mortgage. Like I said before, you're going to have a higher rate on that just to have that flexibility to pay it off at any point. But it is completely open and you can pay it off. So yes, Alterna does have that option.
Perfect. Thank you, Adam. Now there's someone asking about the FHSA program. Do you want to take that one on, Jason?
That's the first time
Yes.
home buy. Yeah.
Yep.
So we are working on that. We'll be rolling out some updates to our members later this year as to the status of that. We're expecting to have it sometime later this year. So keep an eye out for updates by email from Alterna as to the details. So we will be having that. It's just not currently available at the moment.
Okay, great. Thanks, Jason. Like I said, I think initially there were a lot of inquiries about credit score. This one is it considered, what is considered too many inquiries on the credit score? Is it 3 to 4 inquiries risky, they're asking?
No, I would say like 3 to 4 inquiries. It's not really the amount of inquiries, it's if it's a lot in a short period of time. So I would just say that if you have a ton of inquiries, but they're over like years after years, that's not really a big issue because your credit score has enough time to recover. But if say you have like 8 or 9 in a 2 or 3 month span, that's going to potentially impact your scores in the short term just because the amount of hits that you're getting done. So I wouldn't say like there's a set number per se, but I mean, the more you do, the more it's going to impact your credit score over a short period of time.
Perfect.
Exactly. It's the timing that more than anything. And I would say having multiple inquiries is not necessarily a decline automatically.
No.
We understand that, you're shopping around for a mortgage, you want to get a good rate, or you want to see if you qualify for maybe perhaps a little bit more here, a little bit more there. Different lenders have different policies and criteria about how they qualify income. So it's not necessarily the worst thing, and it's not going to automatically mean you get declined for mortgage if you have 5 inquiries on your bureau in the last 2 months. it just causes us to take a closer look and understand why do you have so many inquiries.
Exactly.
Perfect. Thanks so much. Another question that we have is around, just give me a second here. Sorry, I'm just trying to scroll through because there's new ones coming in all the time. Like I
That's
said, a
good.
lot, yeah, a lot about credit. Hold on a sec here. Some people again are asking, and I know you went through this, Adam, about the bridge loan. So one's really specific. Said you said something. I guess he's saying about SLOC instead of a bridge financing. Would the SLOC be on buying property or selling property instead of getting a bridge loan? Does that?
Yeah, I mean, I think it means, so it would typically be on the new property because we're gonna have to register it with the new mortgage. So you'd want to do it on the current house that you're purchasing just to reduce the amount of bridge financing that you're gonna need. So it's just done in a way so that we reduce the amount of interest you're gonna pay, and you'll have it for later on after your home sale goes through. They'll pay off the amount on the line of credit. They'll pay off the bridge. You'll have a line of credit that's free and clear. Now, obviously, we still have to go through the process and qualify you for and do it to the max. We can still only go to 80% of the property value as long as you qualify for, but that's what we would go to, and then obviously do the bridge for the difference. Yeah, I think that's pretty much it. You don't typically want to do it on the property you're selling just because you're going to incur additional fees to get it registered if you don't already have it. And then that way you're only going to have it for a short period of time. And then you're going to be paying $600 just for something that's like a month. So it's typically always on the new property.
Perfect. And there were a few people that have asked if we're going to share the presentation, so I may as well just address that now. The presentation will be sent to you via email tomorrow. We're going to have a follow-up email, and the link to the webinar will be sent out. So if you didn't have a chance to see the beginning, let's say, or you want to go and review it again, we will be sending that out for you. And another question that we have is around it says, is having 2 months of your monthly mortgage payment upfront part of closing costs? So I think what they're trying to ask is, do you have to have that 2 months of your mortgage payment available when you close?
Jason, you want to take this one, or do you want me to
Yeah,
take
I'm
it?
just trying to process that.
I think
No,
it's
not
no, yeah.
necessarily. You need to have, we need to see that you've set aside around 1.5% of the purchase price for closing costs. That's how much we'll want to see that you have available to you, in savings, or as a gift. But we need to see that in addition to your down payment, just to ensure that you have the funds to be able to close. Adam talked about some of the closing costs that are involved in a typical transaction, between land transfer, lawyer fees, appraisal costs, insurance, all those things. They can add up, and we want to ensure that applicants have those funds available to make sure that the transaction goes through on closing day. So that's what we do require. The amount, again, will depend on the purchase price. So it won't necessarily be, something like 2 months of mortgage payments, but depending on how big the mortgage is, it might be in and around that, that same ballpark. But generally speaking, it's going to be a little bit more. It's going to be 1.5% of the purchase price.
Thanks, Jason. Adam, this is question around that home ownership that you talked a little about. Question is, what liability does a shared mortgage have for the parents?
So they would be equally as responsible if they're going to be on title. So it's a shared percentage of everyone on title. So it would be considered their property as well. Now, they might not be living in the property, but they're going to be registered on title, just because the other applicants they wouldn't have qualified if they weren't on title. So it's a shared responsibility. But yeah, it's a way for us to get more people qualified for mortgage, for purchasing a new property where they wouldn't otherwise. So hopefully that answers it.
Perfect. Thank you. And we're just going to take a couple more because we're coming close to time. So there's one question. Does Alterna use a stress test?
Yeah, I
Yes.
can take it. So, okay. Yeah, so we do stress tests. So the stress test is right now, so it's based on 5.25% or the contractual rate that you have plus 2%. So we stress test you on the higher of the two.
Perfect. Okay, I think we're going to wrap it up as we are coming close to time. Thank you both, Jason and Adam. Lots of amazing information. I learned a few things myself.
Great.
Like I said, we had so many questions. Thanks to everybody for participating. If we didn't get to your question, we will definitely reach out to you with an answer tomorrow or later this week. And as I said, tomorrow we will send out a link to the webinar, that the recorded webinar. In addition, there's going to be a really short survey, and we'd love for you to just answer the survey. It's let's say just a handful of questions. We always want to improve on the webinars that we do, so your input's really invaluable. So again, I want to thank Adam and Jason, and for all of you that joined us online. Hopefully you learned something, as I did, and will join us again for we do have a number of webinars coming up. So just check your email, and we'll be sending out our future webinars to you. And that's it. So thanks again, and have a great day, everybody. Bye now.
Thank you. Bye.
Thanks everyone for joining. Really appreciate it.